Imagine walking into a crime scene. But instead of yellow tape, you see, I don't know, broken calculators, misunderstood accounting standards, and just the shattered scores of aspiring accountants.
Okay, that's a bit dramatic, but I see where you're going with it. And a postmortem is actually not a bad analogy for what we're doing today.
Right. The victim here isn't a person, it's the candidate scores from the September-December 2025 financial reporting exam.
Exactly. And these examiners' reports, they really are autopsies. They show you exactly where things went wrong, incision by incision.
And most people just see them as, dry feedback, a list of complaints. But we're treating this as a shortcut. If we can see where everyone else tripped the wires, we can avoid them ourselves.
That's the key. The goal isn't to mock the mistakes. It's to understand the why behind them. The culprit is almost never bad luck. It's a series of very specific, recurring misunderstandings.
So let's map out our mission for this deep dive. Where are we headed?
We're hitting 3 distinct battlegrounds. First, the rapid-fire Section A, which is all about objective testing and spotting those hidden traps.
Okay.
Then we'll do a deep technical dive into Section B, specifically looking at a disaster zone around IFRS 16, leases, and finally Section C, where the math has to meet the storytelling, in analysis and consolidation.
Perfect. Learning from other people's mistakes is my absolute favorite way to learn. It is so much less painful. So let's jump right in. Section A and the group mindset. The report kicks off with a case study, Global Co. What was the setup?
So the theme here is the counterintuitive nature of consolidated accounts. You've got Global Co., the parent, and STEC the subsidiary. STEC sells some machinery to Global.
Okay, sounds like a normal business deal. A company sells an asset to another one. Why is that a trap?
Because in consolidation, you have to stop thinking of them as 2 separate companies. You have to start thinking of them as a single economic entity.
Right.
A group cannot make a profit by selling things to itself. It's like taking money from my left pocket and putting it in my right pocket. I haven't actually made any money.
Okay, so step 1 is getting rid of that unrealized profit.
Yeah.
The report says most candidates actually got that part right. They saw the $112,000 profit and stripped it out. But then
they hit a wall. The vast majority missed the second step, the depreciation adjustment.
Okay, so what's happening there?
Well, think it through. STEC sold the machine at an inflated price, right? That price included the profit. So Global, the buyer, has recorded the asset on their books at that higher value.
Which means when they go to calculate depreciation, they're using that inflated number as the base.
Precisely. They're calculating depreciation on a value that, from the group's perspective, is imaginary. So the group has been overcharging itself for depreciation.
Ah, I see.
In this case, it was a 10-year life, so the group was overcharging by $11,200 a year.
So eliminating the profit is the big, obvious hit. But the depreciation adjustment is the subtle aftershock.
That's a perfect way to describe it. To get to the true retained earnings, which was $1.74 million, you had to add that $11,200 back. You're correcting the expense.
That is sneaky. It feels like the examiner gives you the big number to distract you from the smaller secondary effect.
It's a classic design choice in these questions. Always look for the knock-on effect.
Let's move to the next crime scene, Gamara Co. This one shifts from subsidiaries to associates. Just to quickly clarify for anyone listening, what's the difference?
2 words, control versus influence. A subsidiary is when you have control, usually over 50% ownership. You're calling the shots. An associate is just significant influence, usually between 20% and 50%.
And in this case, Gamara bought 30% of Shinty Co. So because we don't control them, we can't just mash the accounts together line by line.
Nope. We have to use what's called the equity method. And it's a very specific formula. You take your cost, you add your share of the post-acquisition profit, and this is the critical part, you subtract your share of the dividends paid out.
And looking at the report, that's where the carnage happened. Why is deducting a dividend so confusing for people?
It was a bloodbath. The correct answer was $214 million, but everyone was getting $219 or $221 million. It's because it feels wrong. You think, wait, they paid me a dividend. That's income. That's good. Why am I subtracting it?
Yeah, that's exactly what I think. I got a check. My value should go up.
In your bank account, yes. But the investment and associate line on your balance sheet represents the value of that company you invested in. Think of the associate as a piggy bank.
Okay.
If the piggy bank pays cash out to you, the amount of cash left inside that piggy bank has gone down.
Ah, okay. The cash left the associate, so the associate itself is worth less than it was a second before the payout.
Exactly that. You have the cash now, but the investment value on your balance sheet has dropped. You have to deduct the dividend.
Any other traps in that one?
The classic time apportionment. Gamara bought the shares in January. Year-end was September. That's 9 months. Many candidates took the full year's profit. You only get credit for the profit earned while you own the shares.
It's always about reading the dates, isn't it? Okay, one more quick hit from Section A, Beekle Co. This was a loan note.
Yeah, this one was on amortized cost, which is an examiner favorite. So Beekle invests in a loan note, face value, $3.5 million. But, and here's the hook, they bought it at a massive discount, $398,000 less than the face value.
So they paid about $3.1 million for a $3.5 million IOU.
Correct. Now, the big mistake was that candidates calculated the interest income on the face value, the $3.5 million.
Why is that wrong?
Because your actual return isn't just the coupon payment, it's also the fact that you bought it cheap and you'll get the full amount back later. That discount is effectively extra interest spread over the loan's life. So you have to calculate the effective interest on the discounted opening balance, the $3.1 million, if you start with the wrong opening number.
But the whole thing collapses.
From line 1, your answer is just dead in the water.
All right, let's wade into Section B. The examiner's report highlights a case study on a company called Clock & Co. The topic is IFRS 16, leases.
The leasing labyrinth. I call it that because if you take one wrong turn, you are completely lost. Leases are binary. You either get the principal or you just spiral.
And the report says candidates really struggled here. Let's start with the basics. The examiner asked a theory question. What actually is a lease?
Seems simple, doesn't it? But it stumped people. To be a lease under IFRS 16, you need 2 pillars. 1, an identified asset, and 2, the right to control the use of that asset.
And was the trap about timeframes?
Sort of. People thought it had to be defined in days or years, but it could be defined by usage, like miles on a car. But the bigger error was about ownership. A lot of candidates seem to think that a lease automatically transfers ownership at the end.
Which it definitely doesn't. If it did, it would just be a sale on credit.
Precisely. It's a hire purchase. A lease is about the right to use, not ownership of the actual thing. Missing that means you've missed the entire point of the standard.
Okay, now let's get into the exemptions because this is where it got messy. You can avoid the headache of lease accounting if it's short-term or low value.
Correct. But the rules for how you elect those exemptions are different, and candidates were just guessing.
Okay, break it down for us.
Right. Short-term leases, so anything under 12 months. The rule says you have to make that choice by class of asset. You can't just pick and choose. You can't say, I'll exempt this forklift but not that one. It's all forklifts or no forklift.
It's a bulk decision.
It's a bulk decision. But for low-value assets, we're talking tablets, office chairs, you can choose on a lease-by-lease basis. You can exempt one laptop lease but capitalize another.
Why is there a difference?
Materiality, really. A fleet of trucks is material. A few iPads, not so much. But candidates were mixing these rules up all over the place.
I can see why. It feels like a rule designed to trip you up. But the real heavy hitter, the question that drags scores down, was the sale and leaseback.
This was, without a doubt, the hardest calculation in Section B. So Clock & Co. sold a building for $7.4 million and immediately leased it back for 5 years.
A common way to raise capital. Get the cash, keep using the building.
Exactly. So the question is, what's the gain on the sale? Now, normally, if your carrying amount is $5 million and you sell for $7.4 million, your gain is $2.4 million. Easy.
But I'm sensing a big but coming.
The but is that you leased it back. You didn't really sell all of it. You kept the right to use it. The standard says you can only recognize the gain on the portion of the rights you actually transferred to the buyer. You can't book a gain on the part you kept.
That makes sense. You can't profit from selling something to yourself if you're still using it. So how do you calculate what you kept versus what you sold?
You look at the lease liability. The present value of the lease payments was calculated at $7.123 million. The building's total value was $7.4 million.
Whoa. So the liability is almost the same as the building's entire value.
Exactly. It means Clock & Co. effectively kept almost all the value of the building in the form of a lease. They only really sold a tiny sliver of the rights.
So they shouldn't be booking that $2.4 million gain.
Not even close. You have to apply the fraction. The rights they actually transferred were only about 3.7% of the total value. So you take that potential gain of $2.4 million and you only recognize 3.7% of it. The real answer was about $90,000.
Wow. From $2.4 million down to 90 grand.
And most candidates just book the whole thing. It's a tough concept until you realize the sale isn't really a complete sale if you haven't truly let go of the asset.
That is a huge takeaway. Okay, let's move to Section C. This is where it's less multiple choice and more spreadsheets and writing. We have ACCA Co. which was an analysis question.
Right, the storytelling section.
Yeah.
And the examiner's report was pretty brutal here. The big finding was that candidates are good at calculating ratios, but they are terrible at explaining what those numbers actually mean.
The dreaded so what factor.
Yes. Candidates would calculate that gearing so debt versus equity was higher and just write gearing is higher so it's worse. End of story.
Which seems logical on the surface. High debt is bad.
Not always. And not in this scenario. ACCA was looking at buying one of two companies, Coral Co. or Reef Co. Coral Co. had huge gearing, over 100%. Reef Co. was low, about 33%. If you stopped there, you missed the real story.
So what was the story hidden in the notes?
You had to dig into the notes.
Yeah.
Coral Co.'s debt was due for repayment in 2 years. Reef Co.'s debt wasn't due for 8 years.
Oh, so it's a ticking clock versus a long-term mortgage.
A huge difference in risk.
Yeah.
Can Coral Co. refinance that mountain of debt in 24 months? That's the critical question that most candidates missed because they were just fixated on the raw percentage.
There was also a little trap with foreign exchange, wasn't there?
Yes, a Forex gain of $1,000. It seems tiny, but it had a big implication. Some people misread it as a loss, which is just a reading error. But the smart analysis was realizing that this gain inflated the operating profit margin.
So the company looked more profitable than it really was, just because of a currency swing.
Exactly. A good analyst strips that out. Forex gains are volatile, they're one-offs. You want to know what the sustainable underlying profit is, not how lucky they got with a dollar this year.
The report also basically screamed at candidates. Use headings.
It sounds so simple, doesn't it?
Yeah.
But it structures your thinking. The question specifically asked about control. Many just ignored it. If you write a heading on your answer sheet that says assessment of control, you force yourself to answer that part.
It's a psychological hack for yourself. And the final piece of advice was, make a recommendation. Don't sit on the fence.
Yes. Don't just list numbers and shrug. Say, based on X and Y, ACCA Co. should invest in Reef Co. Commit to a business decision.
Okay, final segment. The consolidation beast. This was Partridge Co.
This is the heavy lifting, preparing a consolidated P&L. And this is where we see what the examiner calls a fundamental error.
That sounds ominous. What's a fundamental error?
It's an error so basic that it invalidates your entire answer for that section. And in this case, it was time apportionment.
We saw this back in Section A. It's a recurring problem.
Huge weakness. Partridge acquired Strawberry Co. on July 1st. The year end is March 31st. That is exactly 9 months of ownership.
So you can only include 9 months of Strawberry's revenue and expenses.
You'd think that's obvious, but people added the full 12 months. Or, and this is a weird one, some took 80% of the revenue because they owned 80% of the shares.
Which is completely wrong. You control 100% of the operations, even if you don't own 100% of the equity.
And if you made either of those mistakes, it was a fundamental error. You get 0 marks for the aggregation part of the question. 0.
Ouch. So checking the dates is literally the most profitable thing you can do.
Absolutely. Circle them in red ink.
Okay, what about deferred consideration? Partridge agreed to pay $2.4 million a year later.
Right, time value of money.
Oh.
A promise to pay $2.4 million next year is worth less than that today, so you have to discount it to its present value, which was $1.982 million.
But then as time passes, that value grows back up to the full $2.4 million.
Yes, and that growth is an interest expense. We call it unwinding the discount. You have to charge that interest for the 9 months. The trap here was classification. Many put it in operating expenses.
Why does that matter? An expense is an expense.
It matters for analysis. It matters for your operating margin. This is a finance cost. It belongs below the operating profit line. Putting it in admin expenses distorts the true operating performance of the business.
Precision again. Okay, one last technical trap, intragroup trading. We're back to selling to ourselves.
We are. Partridge sold goods to Strawberry. 2 steps to clean this up. Step 1 is easy. Eliminate the $3 million of intercompany revenue and cost of sales.
Step 2 is the tricky part, the inventory.
The provision for unrealized profit, or PURP. At year-end, Strawberry still had $900,000 of those goods in its warehouse. Partridge made a profit on those goods. Since they haven't been sold to an outside party, that profit is unrealized. It has to go.
And how do you calculate it? This is the markup versus margin trap, right?
Yeah, the classic. The question says Partridge applied a 25% markup. The common error. Calculated 25% of $900,000.
That sounds right, though. 25% profit?
No, and this is the hill students die on. That would be a margin. A markup is profit on cost. So if you mark something up by 25%, the selling price represents 125% of the cost. The math is $900,000 times 25 divided by 125.
Which gives you $180,000, not $225,000.
Exactly. It's day one accounting, but under exam pressure, people just revert to the simpler, wrong calculation.
We've covered a lot of carnage here. It feels like a minefield. Is there any good news? Any silver lining in this report?
There is. It's called the own figure rule.
I like the sound of that.
It's the most forgiving rule in accounting exams. Let's say you mess up the goodwill calculation right at the start. If you then use your wrong goodwill figure correctly in all the subsequent steps, like an impairment review, the examiner will give you full credit for your method.
So you aren't penalized over and over for the same initial mistake.
Correct. They are testing your understanding of the process, not just your calculator skills. If you show your workings, you can still pass. But if you just write down a wrong number with no workings,
0 marks.
0 marks.
That is a huge takeaway. Show your work. It's your insurance policy. So, to summarize the ultimate lesson from this examiner's report, what is it?
It's not about memorizing obscure standards. It's 3 simple things. 1, read the dates. Seriously. 2, read the specific requirement. And 3, tell the story behind the numbers. Don't just calculate, interpret.
Be a translator from math into business reality.
That's it, exactly.
Before we sign off, leave us with a final provocative thought to chew on.
Okay, let's go back to ACCA, the whole idea of control versus risk. In the exam, it's a checkbox, right? We own 55%, we have control, done. But in the real world, ACCA was picking between the high-debt company and the low-debt one. Many candidates picked the low-debt one, REEFCO, because the numbers look safer. But here's the thought. Is a company with better financial ratios actually a better investment if you don't have the power to steer the ship? Sometimes the riskier-looking company, where you actually have control, is the safer long-term bet because you have the power to get in there and fix it. You're not just a passenger.
That's a great perspective. Just because the dashboard looks good doesn't mean you want to be in the car if you can't touch the steering wheel. Thank you for that. For everyone listening, go back to your notes, check your dates, and we'll catch you on the next deep dive.